Hello, everybody, and welcome back. Today we're going to discuss a topic that is near and dear to my heart because what ultimately ended up happening with this particular section of learning how to become a trader, when I fully grasped this concept and its significance, which is I'm giving it a really big build-up right now, and ironically it's one of the shorter chapters or shorter lessons that we're going to discuss, is game planning. I can tell you that in my own personal trading, my own real-world results, the difference between learning and understanding how to put together a game plan versus going to the market each day and not being fully prepared with scenarios that match your strategy, which I'm going to flat out tell you, especially for active traders, is how a lot of people attack the market. Basically, the lesson is they go in every day, or not the lesson, it's not even the right word, it's the methodology that a lot of people use. They'll go to the market every day, maybe have some stocks that were active pre-market, some stocks that might have been up or down a lot from yesterday, and then go in and see how those stocks react on the open, and they feel that those are the stocks that they should be involved in that day. That is not the way to make a consistent living. And again, I'm going to keep building it up to make you understand how significant it is. When I learned the significance of game planning, and when I actually spent the time to learn how to game plan and then actually only trading the stocks that I game planned every day and being completely okay with letting everything else go that doesn't suit my game plan, the profitability or the chance to be profitable, again, everybody's going to manage trades the same way. We can hand you everything on a golden platter. You still have to manage it. The odds of success increase dramatically when you spend a good portion of your time game planning off of your strategy. Please write that down. Your chance of success increases dramatically when you game plan diligently off of your strategy. Now, that's the misnomer about trading, where everybody believes, you're trading the first 2 hours of the day, you take a 2-hour, 3-hour lunch break in the middle of the day, you trade the last hour and a half of the day, and you're done, and you don't do anything else. Write this down. The money in trading is made during non-market hours. Your job during market hours should just be to execute the plan that you plan for. So you take it from your trading plan, put it into a game plan, and now you just let the market unfold. When I started to do this and when I really learned, and this is actually getting into mentoring, because I didn't have a mentor for probably the first 5 or 6 years where I could really learn from somebody in the business. It was really just learning from my own journal, which is another reason I keep talking journal, and learning from your journal. And again, I know I've mentioned this before, but I'm going to talk about it again. Everybody talks about, learn from your losses, keep your losses small and and that's extraordinarily important. But you got to learn from your winners as well. And the only way to learn from your winners is to know if your edge is strong, when it's strong, and understanding how you made money, not just the fact that you did. I'm going to keep repeating that until everybody really understands what I'm saying. If there's $3,000 available on a particular trade, you got to make what's available. You can't be happy with making $1,000 and saying, oh, that's a third of my mortgage payment, or if there's more available. You have to learn to distinguish between okay probabilities where you could probably make some money 2-to-1 risk-reward wise versus the ones where the probability is outstanding. Outstanding where it's just really obvious. Order flow is obvious. The market's obvious. A particular sector might be obvious. You got to push it and be okay with the consequences if it doesn't make money, and then really make what you're supposed to. But this all comes from understanding how you want to trade, which we talked about, is your trading concept. Trading plan, which is the strategy to implement, to develop off of that concept. And then ultimately what we're going to talk about today is the game plan, how you actually, the rubber hits the road and you're actually doing what your strategy says to do. Okay, so game plan identifies which stocks and markets fit the criteria of your concept and also determine how you are going to trade them. All right, so getting into it, the thought process behind the game plan. First and foremost is be prepared, not reacting. I cannot emphasize this enough. In my extensive experience, which for those of you that know too much detail in my background, I've been mostly a short-term trader. I started out trading commodities on much longer-term basis, but from a intraday short-term perspective or a 1 to 3 day window where you have to really know what you're doing and really have a solid idea of what it should look like for you to allocate money to the market, you do not want to be reacting. You don't want to say, oh, that happened, now I'm going to do this. You should have to be setups and scenarios. Everybody knows them as if-then scenarios. You must have your if-then scenarios, and then it's just a question of execution. If it's the other way around where something happens and you're like, oh, that looks good, let me get involved, That's not trading. That's hoping you get lucky that something happened and it follows through. You don't want any of that. You want the highest probability scenario and then just hop on that on whatever short-term basis you're looking at. Even if you're holding a trade for a month, you're still going down to a shorter time frame to manage your risk. Okay, I actually just spoke to somebody. He does nothing but trade inside candles on the 15-minute chart, and he trades those in the direction of whether they're above yesterday's high or low. Giving you another signal there without even telling you, all right? So it doesn't have to be any more complicated than that, but that's his game plan. Inside candles, above yesterday's high, break out to the upside, take it. Stop losses below there. The opposite, inside candle on a 15-minute chart, below yesterday's trading range, he gets short. Doesn't even look at the other side, but that's a game plan. It's a strategy, an entry, and exit. You need it to be that detailed. And he's not reacting. He's literally sitting back at his desk saying, when this scenario that fits my strategy unfolds, I am planning to do this. Big, big difference, okay? Next, completing the thought process. Look for ideas during non-market hours. This was a huge epiphany for me. Huge. When you literally think, reverse what you normally do during the day. If you're typically one of the most active traders around, or you've been doing it a while, you think you're a trader, okay? You're not a trader if you're coming up with all of your ideas when the market opens. You must know during non-market hours how to identify the scenarios and setups that match your strategy. Mark Sperling is actually adamant about this. And for those of you that don't know Mark, he's in my opinion, he's one of the best traders in the country. And again, that's my opinion. Okay, and I've seen this because I've watched him trade, and you talk to him, and it's all about planning to be prepared. But all that work is done coming into the day. And think about this. So let's say you have a commute going to the office, and you didn't prepare. You're like, I'll get there at 8:30. I'll leave myself an hour's worth of time to do it. Well, what if your train gets stuck? What if you get a flat tire? What if somebody drops coffee on your lap, or whatever it happens to be while you're on the train? Now, all of a sudden, what you thought was going to be an hour before the day where you could do your planning turns into now you got 10 minutes. Now it's 20 after 9 New York time. Market opens in 10 minutes. Are you prepared? You shouldn't even log into your execution system. Planning during non-market hours must be your thought process so that when you get to the market, all you're doing is looking to execute the levels and scenarios you've already planned for. It is infinitely better to trade that way and less stressful. Now you're just sitting back and saying, okay, these are the levels, these are the patterns, and this is the side. Remember what I said in one of the previous lessons. Pick a side, then pick a spot. So your trading plan tells you how to identify a side. Picking a spot is your game planning on what level. Scott does that in his price point sheet. And we also have off the charts that goes out. The price point sheet is all the significant levels that Scott is looking for. So if you want to get a sample of that or ask Scott, shoot Scott an email. I'll be sure he'll be more than happy to talk to you. All right, next in the process of game planning. Market hours should be for executing well thought out ideas or exploiting your edge, kind of what I just said there. I'm a little ahead of myself, but you get the idea. I'm going to keep repeating it. Again, something that I discussed when we were discussing the trading planning in a previous lesson. 97% of the people that attack the market, maybe 93%, will not do the work prior to allocating money to the market. Remember what I told you is the plan for most people and why most people have a hard time in the business. Their entire business plan for trading is this. Have a couple of dollars, open an account, start trading. They don't get anywhere into the rest of it. What's my concept? What's my strategy? What are my tactics? Nothing. And we talked about the doctors. What problem would a doctor have if he hasn't gotten continuing education? You have to ask yourself, what education have I got now? What returns do I want to get? What are my resources? And that's the whole point of T3, the community. Figuring out what resources you have, figuring out what resources you need. And education is a resource, which ultimately leads to experience and continuing education. And then putting those together so you have a good chance. Now again, also remember what I said yesterday about losing money. You want to lose money when you lose money on your best ideas. That one thing I just said to you will dramatically reduce all those paper cuts you get and all the trades that you shouldn't be in the first place. Ask yourself every time before you put a trade on, is this a best idea from my strategy that I'm okay with allocating risk to and accepting the dollar amount of the risk because it's a good idea the way I define a good idea? You want your losing trades to be from good ideas that didn't follow through, not from any idea that didn't follow through. That's how you look yourself in the mirror. So I did a great job trading today. I just didn't follow through. Think about it. I played a lot of baseball. Okay, I played baseball until I was 37 years old. And there were plenty of times that I hit a line drive after line drive after line drive, and I'd go right at somebody. right at the shortstop, right at the second base, whatever, and you hit the ball solid every time. You went 0 for 4, but does that mean you didn't have a good day hitting? No, of course you'd want to hit the ball hard every single time. And that's the same thing with trading. I'm going to repeat it again. You want to lose money when you lose money on your great ideas. Only take the great ideas. But you won't know what a great idea is if you don't know your concept, you don't put a plan together for trading, and then ultimately be able to translate your game plan that we're talking about now from your trading plan. All right, next. Scenarios that are the edge from your trading plan. Okay, I have that in red for a very big reason, something else I want you to write down. They must be from your plan. And I'm going to emphasize this over and over and over again. Stop taking trades you saw on television. Stop taking trades that somebody sitting next to you called out or in the chat room called out. Take your trades only. Until you can be consistently consistent with your own ideas, stop taking somebody else's trades. You don't know if that person had a bad night. Go back to somebody spilled coffee on them on the way in the morning. Take your trades, only your trades. Go on a 30-day diet. Well, let's say there's 20 trading days in a month. Go on a 20-day trading diet where you do nothing but take only your trades. But now let's back up a little bit. Do you have a trading plan? Did you go over all 30, 40, 50 of those questions that I went through and really answer them? If you did, again, you're ahead of 93% of the people. Next in the thought process. Plan contingencies for every trade review and management. When will you review your game plan? And I'm going to give you a little heads up when I do it. I review my game plan, which should be completely done on the 7s. I start at 7 at night or 7 in the morning all the time. When are you going to review that? Well, you have to know what happened overnight, and all of that kind of thing, which you're going to get into in a minute. When are you going to review your game plan? I do it at 8:30 in the morning, prior to an hour before the market opens, and then I review it at 1:30 in the afternoon. I want to know if any stocks that might have been an A order flow trade coming into the day on the longer time frames, but weren't a setup on the last couple of days. Let's say, for example, we're going up, we're pulling back in that stock, and it hasn't quite bottomed out in the way I identifying it bottomed out. Maybe it happened in the afternoon. Maybe between 9:30 in the morning and 12:30, 1 o'clock, now it's 1:30 in the afternoon. Now it's trading where I want it to be trading. And again, hitting those levels that you planned for and should program into your system as an alarm, now goes into your game plan that wasn't there in the morning. Game plan twice a day. You have to do that. Absolutely imperative. Day changes, man. Next, components of a game plan. Which stocks meet the criteria and offer profit potential based on your trading plan? Number 2, define your possible entry scenarios. Now, these are all must be written down. Which stocks meet the criteria? And it's interesting here. Offer profit potential based on your trading plan. It's one thing to have a stock that might go into your plan based on I want to be long or I want to be short. It's a completely other thing for you to say to yourself, well, the stock, it's definitely a long, but it's up 6 days in a row. And there's resistance coming up. So the reward potential is this big compared to here. The stocks and the reward potential have to go hand in hand because let's face it, the business is about justifying the risk for the potential reward. And as the stock keeps going up 2 days, 3 days, 4 days, even if it gets to 5 or 6 days, which is a lot, the reward significantly diminishes. So you have to know if it's a good idea right now. So there's the stock, the reward potential. Next, define all possible trade management scenarios before you put the trade on. And then document how you're going to do it. If we open higher, if we open lower, if we open flat, what are the reference points? And this is getting a little bit more into tape reading, which we're going to discuss a little bit in a later lesson. But what levels, what significant levels, based on the open, do I want to see before I get involved? If I want to be long and we have a higher open, what do I do? If I want to be long and we have a lower open, what do I do? If we have an open that's flat, completely where we closed yesterday, what do I do? How much time has to go by? Am I going to wait for a candlestick to finish? Am I going to wait for a pattern? Write it down. All of it's write it down. You're taking all the stress out of your trading by planning for it. The less you do of this, the more you're reacting, the more you're going to be pissed off and angry at the market versus what I do, what Evan does, what Mark does, what Scott does. You just sit back. And if you listen to some of the trades, this is actually interesting too. If you listen to some of the more experienced traders when they're angry or upset, or you could hear it in the voice. And I've done it where I've been trading and I'm doing mentoring or I'm in the VTF, and you could literally hear it in my voice. Besides, you could see my positions. I'm a little deflated, or my voice just doesn't have that same pep. What's going on there? More often than not, it's a trader trading their opinion as opposed to their plan. In other words, I'm right, the market's wrong, this definitely should happen next, and that kind of thing. So really catch yourself. If we do this, I am definitely doing this. If this doesn't happen, I'm okay, and I'm just going to step on the side or not get involved at all. Okay, next. Define all significant levels to trade around. This gets back to the opening price. Change from yesterday. Today's high or low. The 5-day high or low. The weekly high or low. The monthly high or low. All of these levels, the moving averages, 10, 20, 50, 200, whichever ones you use, Fibonacci levels, Bollinger Bands, Keltner channels, whatever you use, stick to them. Don't keep changing them. Know what reference points you're going to use, jot them down, and the way I like to do it is set alarms. Especially we use Lightspeed software, you can actually type it in, not only put the level, but then put a note in there. Like the high from 4 days ago. If it takes out this level, there's $3 to go. You know, those kind of things. That's planning. Put those plans in place and then let your plan unfold and know what you're going to do beforehand. It becomes infinitely impossible to be consistent if you don't plan. And that's, again, trading plan into the game plan. Okay? Last but not least, define your loss targets and your stop targets. And I say stop targets, I'm talking about your profit targets. Define the target. If you get out and it goes down to that level, kick it out. And again, remember, I talked about this in a seminar we did here a couple of weeks ago, a mastermind meeting. If you're holding on to a trade longer than you plan to, I am telling you flat out what you're telling yourself. Number one, you didn't accept a dollar amount risk on the trade. Number two, you never expected the trade to go against you. And number three, which I think is the most important one that I'd really like for you to remember. If you're holding a trade that's a losing trade, got down to a spot where you said you were getting out and you don't, you're telling yourself one thing. I have to hold this trade because it's the only opportunity I'm going to have to make money. Think about how stupid that is. I've done it. You're holding it. No, it's going to come back in 5 minutes. No, it's going to, and then it slowly drips away. And what was an acceptable, comfortable loss becomes this nightmare because your ego said, hold on to it. There's not going to be any more profits. Next time you catch yourself holding a trade that trades through your stop loss and you don't kick it out, you're telling yourself what I just said. I have to hold this trade because I'm never going to have another opportunity. It's ridiculous. Pull the plug, get out of it, and look for a new trade. Take it a step further. Set a re-entry point. This is a very advanced thing, but I'm going to give it to you anyway. If the idea is still valid, which we talked about in a previous lesson, and you get stopped out, and let's say it's a long, you're up here, you get stopped out down here, and your entry price was up here, set a buy stop limit order to get back into the trade as it moves in your direction, and it'll automatically trigger and put the trade out there while you might even be looking at a different trade. So if it gets back there, there's a difference between getting stopped out and it not being valid anymore. Rewind the tape when you listen to that and you'll understand that strategy. It's a pretty strong one. The idea is still valid. You want to get back in, put the stop in there and you'll get back into the trade because you have the order out there. All right, next. Game plan execution. Actually fulfilling the plan. First and foremost, your number one goal above all others is to find trades that warrant taking the risk because you believe there's a good chance you will earn an acceptable profit. Now, the important part here is good chance. Every single thing we do in trading, and again, take all of the fluff out, everything, all the infomercials, trade is about probability and risk. That's it. And what are the resources that you're bringing to the table that will determine how good can you determine probability? How do you do that? Education, training, coaching, mentoring, real trading, revising your plan and going back. You must, everybody has the problem not having enough experience. You must be diligent with yourself to say to yourself, my number one job is to determine the probability of one thing happening versus another. When it's really obvious, you should say it's really obvious. When it's not really obvious, you should step back and say there's nothing to do because I don't see an edge. Probability and risk. Number one job is to determine, is the probability strong enough for me to take this risk? Is there enough profit potential for me to justify the risk? So there's probability, risk, and profit potential. Those three things ultimately will determine whether or not you should allocate money to the market. But that all should be done by your plan first. Go back, go to the last lesson. All those things in the trading plan ultimately now come to executing the trading plan and determining what is the probability of this idea. All right, next. In other words, if I haven't eloquently described it enough, your job is to wait. I should have put that in red. Wait for trades that have a higher reward potential. Number 2, take every trade with appropriate share size. Again, I discussed this in a previous lesson that it was very, very simple. When I first started trading, I was stopped out of a lot of really, really good ideas. I'd put the trade on, get stopped out of the idea, and then the trade in the afternoon would do exactly what I thought it would do. I'd put the trade on, let's, for argument's sake, say 10 o'clock in the morning, put it on, it would do whatever it was going to do. I get stopped out based on the dollar amount I was willing to lose or risk on the trade, and I look at the stock 4 o'clock in the afternoon, and I bought it here, it was up here, and I got out here. So I made $80, and then should have made $800 on that particular trade. The way to get around this is appropriate share size for how much you have to let the stock fluctuate. Now, we're not going to get into the exact details of all that stuff today. We discussed it a little bit before, but you must have the right share size to allow good ideas to play themselves out. I can't emphasize that enough. It's the most frustrating thing you will ever experience in your trading is to have good ideas and not make money on good ideas. And the number one way to ensure that or to give yourself the best chance is to have smaller share size until you can afford to have bigger share size. It's the only way to put it. And again, I want to touch a little bit on placing your stops, especially in today's world where all the algorithms and high-frequency trading is all in the market and everything like that. If you think your stop loss is $20, put it far enough away from $20 that if you actually get hit, it's a change in direction. It's not just the noise. You don't want to get taken out on one blip down and then it does exactly what you want it to do. I had a trade like that yesterday in Netflix, actually. I was long the stock at 126. I had my stop at 125, and 125 was just outside of the area. When it went down to 125, I actually had my stop a decent amount below that, so I didn't get kicked out, and then the stock actually had a pretty good move. So you got to make sure you're outside the noise when you're placing your stop. That's a big part of planning. Number 3, execute predetermined exit strategies. I just spent quite a few minutes talking about that. And number 4, start over. So here's basically the 4-step recipe for executing a game plan. Number 1, wait for trades that have a higher reward potential. Number 2, take every trade with appropriate share size. And I'll touch on that for a second in a minute. Execute predetermined exit strategies and start over. So it's kind of like shampoo. Repeat once you repeat once you're done. All right. The number 2 here I want to talk about one more time. Take every trade is a key thing there. If you find yourself hesitating on trades that are part of your trading plan. If you find yourself saying, that's a bull flag, that's a bear flag, or that's the breakout I'm supposed to take, and you don't do it, you're trading your past trade. Don't do that. Every trade is unique. Okay? The trade doesn't have memory like that. Just if it's a pattern that formed, is because price action and other people are committing capital. If a scenario comes about and you don't execute the idea, okay, that means you're not in the present moment. Get to today's moment right where you are right now. Put every trade on it. And I'm going to take it even a step further. In order to make money trading, you need to make sure you have enough trades that you make with a high probability of following through to pay for all the small ones that don't follow through. So that means you need a bigger sample of trades. I mean, let's think about it. If you have something that plays out 60% of the time, for example, do you think you have a better chance of making money, assuming you do everything right, if you only take 10 trades or if you take 100? Well, 100's a much bigger sample, and you don't know, if it's going to be 3 in a row, 3 out of 6, that kind of thing. But over 100 compared to 10, much better chance of making money if you do what you're supposed to. Take every single trade because we have absolutely no idea which ones are going to follow through. That's the point that I'm trying to get to there. You could have the same exact bull flag, bear flag, whatever signal you happen to be using, wedge, whatever it happens to be. 2 of them line up exactly the same way in the same stock. One today, one tomorrow, or one today, one this afternoon, okay, whatever it happens to be. You could have completely different results in the follow-through, but you have absolutely no idea which one's going to follow through. So be diligent to set up every single trade, take every single trade. You have no idea which one's going to work, okay? Next, finding those good ideas. Now, very clearly here, the big money and the follow-through is in the order flow in the weekly and daily charts. So that's where you should start getting your ideas. You'll be like, oh, Pete, but I'm a day trader. What the heck would I want to look at the weekly charts? At least get an idea of direction and levels, and that's where the edge is. You'll find when you start working with me personally, everybody knows the cliche, the trend is your friend, the trend is your friend. But I take a little bit different twist to that, and I'm not changing it, I'm just talking about it differently. Trend as your friend can become a cliche. Yeah, blah, blah. I call it order flow. There was a period of time where on my trading floor, I had 20 to 25 former NYSE specialists trading on my floor. And all I did was dig in and talk to them about how did you manage those big multi-million share orders during the day. And they always kept coming back with the same word. Well, we had the order flow, and we worked the order flow. And so I've converted the trend as your friend in my vernacular when I work with traders and when I'm mentoring other traders. I say order flow. What is the order flow? The order flow is the big picture dollar push behind that stock that's going to be pushing it up or pushing it down. So when you're looking at a chart, when you're generating your ideas, you should be looking for obvious order flow. Obvious order flow is big dollars pushing it around. Don't think about the trend. Think about, say this, you should think about the trend, but I'm just trying to get you to think a little more deeply about what you're looking at. Is buying or selling pressure obvious on the higher time frames? That's what I want to get across to you. Number two, intraday charts confirm the idea, or they will alert you when the probability has decreased. So we just talked about the profit potential, how much profit potential still left. How will you determine this? So based on looking at today's chart, yesterday's charts, how far back do you have to go? It's really nothing more than looking to the left on your chart and determining where buyers or sellers did something. So you look to the left, you look to see how much space is out there. The further the gap there is between the current price and where the next big spot where buyers or sellers did something, that should be your profit potential. Potentially should be your profit potential, but that's how you set up the good risk-reward trades, okay? Next, make a plan for what you will do if your edge changes intraday. I actually kind of talked about this before. Briefly, about 10 minutes ago, I just discussed game planning 8:30 in the morning, game planning 1:30 in the afternoon. Afternoon is when I actually start to reestablish my game planning. And there's also a lot of stocks, a lot of you know that I like to use change from the open. So there's plenty of stocks that I might want to be long. I'll keep using the buy side, for example. Stock opens lower. It doesn't fit my criteria right now. I usually get involved when it gets back above the open. So I'm technically game planning right on the open for later if that stock crosses back above. Because now think about what we have. Longer term order flow defining a scenario where I want to be long. And now shorter term intraday order flow or shorter term buying pressure has reestablished itself that it's positive on the day now. So game planning intraday is very important as well. All right, next, trade management. Trade management, very simply, the overriding concept here is not to look for ideas during the day. I think I've stressed that quite a bit now. You want to be prepared. Again, do what I said on the sevens, whatever's comfortable for you, depending on where you live. You want to be executing during the day, not finding ideas during the day. Number two, how do you define and assess profit potential? We just talked about that. Write it down. Look to the left. What specifically does it look like to you? Well, you know what? This is very interesting. What specifically does a profit potential look like to you? It depends on your concept. Do you plan on holding the trade for 5 days? Well, then you're not going to be looking at the last 2 hours. You're going to be looking at the last 2 weeks. How much room is there left to go in the trade? So the profit potential concept is different based on your trading concept. Next, match your risk to your ideas to patterns that will allow you to trade the stock without stress. Very, very important. We discussed volatility a little bit in a previous lesson. You absolutely must know the risk for the stock in order to be able to put the trade on in the first place. If you only have a few $1,000s in your account, you should be trading GE or GM, something that doesn't have massive $1 swings in a couple of minutes. Okay, like for example, right now, the metal stocks are getting hammered as I say this right now, and SLV just came in $1 in about 8 seconds. Got absolutely crushed. So you need to know the volatility so you can set stop losses that are realistic for your dollar amount you're willing to risk and will allow the probability to play itself out. That's probably something I'd really like to see you write down. Make sure you trade the appropriate share size to match the dollar amount you're willing to risk, to match how much you need to let the stock fluctuate to allow a good idea to play itself out. And again, you don't mind not making money on a trade where you did what you were supposed to, even right down to share size, if it changes direction or whatever it happens to be. The ones that really nag at your stomach is when you had a really good idea, didn't make money because you traded the P&L instead of trading the structure of the idea. It's very, very important. Okay, next. Next, are you okay with doing nothing? I hope I've brought that up quite significantly, and I can tell you flat out, if you're okay with doing nothing, you're going to be ahead of at least 50% of the traders. Until you understand what your strategy is and whether or not your strategy is unfolding, you're still going to be doing nothing but reacting. You want to know what your strategy is, know if and when it's unfolding, execute flawlessly like I just discussed when it is unfolding, and then be okay with stepping on the side and doing nothing if it's not. It's very tough when you're in a room especially and everybody's calling stuff out, you don't know, but guy could be sitting next to you, not making a dime, but calling out trade after trade after trade. Stick to your plan because you're the person paying your bills. All right, next. How do you know if you're going to adjust risk up or down? That gets into trade expectation, which we're going to discuss a little bit further down the line. Will you program exits or trade with discretion? This is actually a very interesting one. Do you put in pre-programmed stops, trailing stops, and those kind of things? Or are you only going to do it based on, I'm good enough to get out, I have enough discipline, I've proven it to myself? I'm going to give you a little advice. If you are trading less than a year, even less than 18 months, and have not exhibited the consistency you want, more often than not, I'm willing to bet that you are randomly getting in and out of trades. I'm going to give you a tool or mindset or an execution way to do it. Put the trade on, put your stop loss in, put your profit target out there, and let the trade unfold. Do what you said it was going to do. Unless the conditions completely change, give yourself a chance to risk the dollar amount that you said you were going to risk and earn the potential that you said was in the trade, and let the trade unfold. Again, go on that 20-day diet of flawless performance. That's really what you want. All right, next. Are the conditions you entered the trade still valid? Very interesting. Can you identify those conditions? Where does that go back to? That goes back to your trading plan and ultimately the game plan unfolding during the day. You need to know what conditions got into the trade, and if they're still valid, hang on to the idea. If they're not valid, kick it out. All right? And it will change. Sometimes the announcements get, especially now, all this headline news from minute to minute. Greeks defaulting, they're not defaulting. It's all over the place. I'd like to finally get back to, we just talked about earnings per share. We haven't had that environment in a long time. All right, next, what is your worst case scenario? Manage the downside. All the money in the business is being around long enough for the few times or the percentage of times that trades unfold and do what they're supposed to. If you're always focusing on worst case scenario, knowing what you're going to do and then doing it, it's just a question of matter of learning how to manage trades that move well in your favor. And believe it or not, learning how to manage profitable trades, that's a skill. And that's where a mentor or a coach could really help you raise your level, because I'm willing to bet that if you know basic technical analysis and you're not getting the results you have, the need or the problem you have is somebody to be able to talk to about how to manage a good position. That's very, very important. Again, going back to your resources, you must ask yourself, what do I need to get to the next level? And more often than not, if you have an account, it's really just training, education, or continuing education. The continuing education is really learning how to trade at a different level or holding on to those good trades. And sometimes trading at a different level is not even doing anything different than you're doing now as far as risk or charts or anything like that, or how you're making your decisions. It can be something as simple as holding on to a good trade. And you'd be surprised at how many people want to book a quick profit just because they have it, make themselves feel good. And that's not how you make money in the long run. You got to be able to hang on to some of the good ones. All right, next. Should you build a position or scale out when your position consolidates? Very important. Are you a momentum trader and you get out as soon as it slows down, or are you more of an intraday position or a week-to-week position trader where it slows down, that's where you're looking to add to a position? That's got to be a part of your plan and your trading plan, so that ultimately when you come back to your game plan, when this happens, I'm a trend trader. I'll put it out. I'm a trend trader over 2 months. Stock pushes up and goes sideways, this is a good spot for me to start looking to add to it. I'm a momentum trader. Stock pushes up and goes sideways, I'm out. The momentum stopped. But you got to know that. You got to plan for when the stock slows down, what are you doing about it? What are you doing? Are you adding to it? Are you tearing into it like we call it here at T3? Or are you just putting on that trade and saying, oh, it's done, it just moved X amount, slowed down, I'm out. I'm not going to give any of it back. Okay? And last but not least, what are the different conditions that will dictate which of these you do? And again, I just kind of talk about it. The conditions are one thing, but really it more boils down to the strategy. What is your strategy when the stock or the market slows down? Okay. Next, additional game planning considerations. Number one, is this a good idea right now? And actually, this is an interesting one. This is actually one that I lost money on. Definitely wanted to be short. Market was a screaming short. We were coming down to some pretty big short levels. And QE2 is just ending. It's actually June of this year. Everybody in the planet is saying, well, all these fund managers have to dump. They're not doing the same thing. The government's not backing, blah, 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 all the thing and everything. Going to hell, we're going straight down. Well, if you really look at the charts and really think about it and really think out, is it a good idea now? It was absolutely a short. And the market's actually lower than it was then, about a month and a half, 2 months ago. It's still a good short idea. But at that moment, the fund managers were dumping their shares the prior 2 months. So everybody was thinking that, and myself included, short-sighted. I was counting the dollars in my head about what I was going to make when we collapsed because the government wasn't supporting the bids anymore with quantitative easing too. Well, what happened? They've been dumping the shares the prior 2 months. It wasn't like everybody saying, oh, they're going to start dumping July 1st, but they're doing it for 2 months. So most of the selling was done already. What happens? We had a short squeeze beyond short. We went straight up vertical for about 7 days, and all the shorts who were expecting to hammer the short side when QE2 ended had very ugly P&Ls. Very ugly P&Ls. So it's one thing, is it a good idea? Take the next step. Go a little deeper. Is it a good idea now when you're game planning? Now. That's the thing, because you're getting in now. Number two, is volatility changed? Has volatility increased? We talk about the VIX went from 20 to 45 in about a week and a half, and now it's staying up in the 40s. So volatility increases. How do you plan for that? You reduce your share size, expecting stocks to fluctuate more so that you can stay in those good ideas and allow to give them a chance to play itself out. That's how you plan for an increase in volatility. Okay, next. What macro news do I need to know? Very important. I mean, Europe is a mess right now. The European Union is changing their idea. Everybody's giving you an opinion every day. What's going on in the big picture? Now, I'm not saying to stay up every night and read Financial Times and everything you could possibly read on the internet. Wake up in the morning and first thing you should check is what's going on. Anything significant happen in the big picture? Okay. Next, what sector-related news do I need to know? You know, if you're trading Texas Instruments or Intel or Citibank, whatever it is there something in my sector that might or will affect the stock that I normally trade that I have in my universe? It's very, very important. Sector related, like whether it's housing starts or anything along those lines. What significant is going on that could affect what I'm normally looking at? So if you're game planning a stock and something significant happens to another stock in that sector, even though it's not the one you're trading, you better be aware of that, and that's got to be a part of your pre-market ritual, which is another reason I do my numbers on the 7s, 7 at night, 7 in the morning. All my game planning of what I want to do is done. Now that last hour or so is really more, has anything happened this morning that might affect what I plan on doing? And sometimes it does, and you're like, you know what, I got 7 other ideas. This idea is up in the end now because of that news. Sometimes I will pull it back and say, I'm going to go and trade the stuff that's not being affected, okay, or it doesn't have an external factor other than what I'm reading on the charts. Okay, next. How did the market trade overnight? Everybody must know, everybody who's got some sort of PDA, or whether it's BlackBerry or iPhone or whatever it is, first thing any trader will do in the morning is log in, pull it up on their charts, and see what the futures are doing overnight, which actually is going to be interesting. I'm going to talk about that on the next slide. Where do I expect the market to open today? What do I plan to do if it does or if it does not? Which is actually going to take me into this slide here. Okay, this is the final slide here in the video. Tomorrow's open. More often than not, it's the most confusing time of the day for most traders, and I'm going to tell you why. Heading into the day, there's buy orders, sell orders. Everybody listened to Kramer last night. Everybody, whatever, out seeking alpha, all the different places that they like to watch. And then everybody feels that the market is this one big, giant, conglomerate mess between 9:30 and 9:50. I'm going to say 80% of the time that's true. Okay, 80% of the time. But here's the interesting thing. 20% of the time it's not. 20% of the time the market opens exactly how you expected it to do. So we can just take a look at the slide. I want to run down the numbers here to walk through exactly what is interesting about how you can capitalize on the 20%. Now think about this. If most traders are staying away from the market in that first 20 minutes because 80% of the time it's a mess, let's reframe that a little bit. Let's get to the point where what if we plan for something that we expect to happen on the open, and it actually happens? Why do most people stay away from the open? It's the most volatile time of the day. Stocks move the fastest on the open. So let's think about this. The stock closes strong yesterday. Let's say strong means it closes in the top 20 to 10% of where it is. So it's a big green candle on that daily chart. What should happen in that stock the next day? That stock should open higher. I'm going to give you some stats. 80% of the time it does open higher, 20% of the time it won't close higher. Excuse me, 50% of the time it won't close higher. So now we're talking about 80% of the time it will open higher, 50% of the time it will close higher. So let's think about that statistic for a second. What if it actually does open exactly the way you expected it to? Do you have a plan for that to take advantage of that first massive spike in volatility and be up a really decent amount of money relative to whatever you normally trade in that first hour? We'd be like, well, what about the other times it doesn't? It could, you know, I said 80% of the time it does open higher. 10 minutes later it could go lower. But what about the 20% of the time it actually stays there? Or the 50%, or whatever the number happens to be, okay? If you are ready and have an expectation, I'm going to tell you what I do, and I want to end this lesson with that. Have an expectation for the open based on yesterday's close. Practice game planning for expecting to what should happen on the open and plan for what you plan on doing if it does exactly what you thought it would do. Focus on the time it does, and you're going to be saying to yourself, my God, I had 8 stocks. 6 I expected to open higher, 2 I expected to open lower, 1 open higher, 1 open lower, exactly the way I thought it would. And they exploded for $2 in the first 20 minutes. How are you going to trade that? I'll leave that with you today. Have a great day, everybody.